What up? What up?
Stan the man, what's up, bro?
What's going on? Sorry it took so long for me to hop in. Just getting situated over here with my whole setup.
Oh, you good? I literally just got in 30 seconds ago.
Good. Everyone's just coming back from the office, getting back from traffic. So let me get some drink real quick. Right. We got in here. Here we go. Can everybody hear me and see me clearly?
Hey Stan, yeah, can hear you.
What up, Renville? Carlos said he'll be back heating up some food.
Yeah, I'm right here. I'm just grabbing some food, guys. Give me 1 second. I'll jump on right now. How was your vacation, Stan?
It was great, man. Got to see a lot of family. My sister flew down from Virginia with her family, and so we had a big family gathering. We got to see all of our cousins that are living in Hawaii. So it was nice. A little long for me. More than 3 days in Hawaii is a little too long. I grew
How
up
long
there.
were you there for? Like a week?
I was there for 8 days. So I came back like Thursday morning. Back to the cold. Always fun.
Back to the cold.
Yep.
Yeah.
It was a late night flight, but then our little one was super cranky, like on the way back. On the way there, she was great. She was quiet. She slept like literally the entire time. And then on the way back, every hour she was waking up. I felt so bad. And we had like the seats that were a little bit less comfort space. And then on the way there, we had a lot of comfort. So yeah, it was a little rough coming back home, but it was good overall.
Yeah, bro. It looked fun. Looks real fun.
Good times. It's always nice when you get to see family. For the ones that have kids, it's a little bit different. When I went back like 2 years ago, I was looking at my old photos. It was like 2021 of March. My little one was barely talking. So it was nice that she's seen her cousin. They're like 2 years apart. So it was cute seeing them interact with each other, just fighting over toys. But when you have a kid, it's like totally different, and growing up in the house and bringing in a family is just like really weird. I was like, we grew up in here. Now we got family and kids. So
Yeah, that's cool.
Comes full circle.
Yeah, it definitely does.
Yeah, man. That's crazy.
All right.
Cool. I'm gonna be on the side real quick. I'm still making my food, so be on the side.
Do your thing. Does everybody have the updated calculator? Do you guys have the updated calculator? No?
I don't think I do. No.
Okay, I'm gonna drop it in the chat. Let me drop it in here. I update this pretty frequently, like every so often, and I just added some more new stuff in here. So you guys are in for a treat today because you guys are getting the latest updates. Because I always add some stuff that I like that obviously would benefit you guys. So give me a second. Let me find that link. I'm gonna drop it in the side chat right here. But every so often, you guys can double check this this file. I always put last updated and whatever the date is. So you'll see when I add some stuff. Let me see if I can. You guys got that? The link on the side chat? Perfect. And then I'll go over some of the new stuff that I added in here once we start going. I think we might have a smaller class today. I don't know if Carlos put it up on his social media. Cool. Oh, John, thanks again for that drive that you shared with me.
Sure, man.
I'm on day 3 on it.
Yeah, it's good stuff.
Let me see what I can find. Are you focusing more on multifamily now? Or are you kind of doing both?
No, the multifamily is all I'm doing now, bro, as of December.
Yeah? Oh
Yeah.
shit. Let's go.
Yeah.
Where are you?
I'm
What market?
Texas and Florida, and definitely more leaning towards Texas.
Yeah, I would say just pick one market, bro. Because 2 different states it gets a little confusing just because of the laws behind each one.
Yeah.
But as you gain experience, then just kind of traveling to a different state is a little more simplified. But I would say, like I always say to everybody else, focus on one market. I don't even focus, to be honest, I don't even focus here in Vegas. The only reason why I do it here is because obviously we live here. And obviously the investors want properties in Vegas, but for myself, if I'm investing and putting my money in trying to find partners, I'm focusing on Texas. So, yeah. How about you, Renville? Are you doing both?
Yeah, I'm still getting some single family just for more cash flow, but I am doing a multifamily in Cleveland.
Yeah.
I am waiting on some financials from a broker in Cleveland for 27 units, so it's in the works.
Awesome. Good stuff. Good stuff. What up, Jennifer?
How's it going?
Have we met?
I don't think we've met. I've sat in on about 3 of these, but working at the same time. So I'm just trying to get one down.
It's always that one,
Yeah.
that's what I always say. The first deal is always the hardest deal. And then once you
Just
figure it out.
even one of these Zooms.
Yeah.
And like halfway through, back and forth. So I'll pick up the phone, people are calling me nonstop. I run a transaction coordination business, so I have people calling me all day long. So I kind of,
Awesome.
yeah,
Where,
I can't.
where,
I'm sorry.
where are you based out of? Where are you based out of?
I'm in Southern California, Riverside County. I'm about an hour, I would say about an hour and a half from Carlos, west.
Okay. Yep. So you're closer towards Palm Springs, like about an
No,
hour and a half.
Yes, hour and a half west of Palm Springs, or
Gotcha.
maybe an hour, maybe only an hour. I drive fast.
Heavy foot driver.
Yeah.
Yeah, my girl's the same. She was driving my car and I was like sitting in passenger seat and I was like, babe, you gotta slow down. She's like, what? I'm going speed limit. I'm like, no, you're not. You're freaking speeding through the airport.
I was coming back from, my son plays baseball. So I travel around. I used to travel around. Now he's in college. So I just sit here and work all day. But I was driving back from a tournament in Utah and I got pulled over, and the lady officer, she said, is there a reason why you're going 95? And I was like, because it's just so beautiful out here. I haven't been paying attention to the speed limit. But I don't even know what the speed limit out there, but I know it's higher than it is out here. I think it's like 80 or something, right? Or 70.
No, we don't. No, here is 65 is the highest sign that we see within the city.
You're in Vegas though, right? Nevada?
Yeah.
Yeah, it was Utah. I think Utah's higher, but whatever it was.
Yeah, I think it's like 75 for Utah.
Oh,
But that's
okay.
like in like open road on the way to Utah when I seen it.
Yeah, I was on the highway and she helped me out by making it, within like 10 miles rather than, so I got like the lowest infraction, I guess. So that was nice of her, but I guess the compliment I gave her about her state maybe helped.
Yeah, that's funny. I remember my best friend and I were heading to Utah back in the summer, like I forgot how many years ago, maybe 2010. We're going on a snowboarding trip. He was driving. He gets pulled over. This is going towards Bryan Head. He gets pulled over. Within 5 minutes, he gets pulled over for a second time. But he got let go the first one. The second one, he did get a ticket. But he got pulled over from 2 different cops. And just from crossing one, I don't know how many miles, it was going to a different jurisdiction.
Oh, wow.
So yeah, within 5 minutes, and he wasn't even going super fast either. I think he was going probably like 5 miles and over. And the second time that he got pulled over, it was just funny.
Oh, yeah. No, I catch myself way over all the time. I think I used to live in Venice Beach area, and I worked in South Bay, and I would drive down, it wasn't PCH, maybe it was PCH, yeah. But there was a part where it's just, I think the speed limit's like 35 or something. And I got pulled over one time. I think I was going 70. I don't know, but I was late for work.
It's always the case, right? It's either you're getting late to somewhere or you got to use the bathroom really bad.
Yeah, I've gotten lucky. Cops have kind of helped me out as far as being able to go to traffic school and whatnot. But anyway, back to this topic. I'll let somebody else talk.
All right. We got Jacob. What's up, Jacob? Have we met?
We have not, man. This is actually my first time catching one of the multifamilies.
Nice.
Catch them on
Welcome.
YouTube.
Okay.
Yeah.
So you watch our YouTube videos. Are you investing in multifamily right now or just starting to get into it?
So I'm trying to branch off into my own. I am partnered in a couple here in LA, and then we have a couple of units in Vegas as well. So
Okay, so you already have units.
altogether, like a mix between single family and multi, about 100 doors.
Nice, very nice.
Yeah, but I'm
you're-
not the main partner, I guess. I'm mainly
Yeah,
partnering with my
LP.
mother-in-law. What's that?
Okay, you're an LP limited partner.
Yeah. I transitioned. I used to play professional basketball overseas, so I
Okay.
transitioned from that and kind of met my wife, and she, her mother-in-law or her mom, my mother-in-law, has been an investor for like almost 40 years now. So she buys all over LA and Vegas. So
Very nice.
yeah.
Oh shoot, that's what's up.
heck
Well, if you
yeah.
guys ever need anything in Vegas, obviously I'll be your guy. I'm licensed out here as a commercial agent, so do this every day.
Definitely, heck yeah, yeah. I think she's looking more so. She's starting to look in Florida actually, because my brother-in-law, her oldest, moved out there to Palm Beach County, out in near what is that place? Palm Beach Gardens.
Okay,
Which
I'm not
is
too familiar
like,
with Florida, but I think Daniel Naharo is from Florida, right, Daniel?
Yeah, man. I'm in Miami.
Yeah. So
yeah, so that's about like 30-40 minutes away, right? Yeah.
Yeah. So
Palm
Daniel's
Beach Gardens.
he's licensed as well. So connect with him for Florida.
Yeah,
Yeah,
I'm gonna drop my
definitely.
number in the chat. Yeah, man.
Heck yeah, man.
Yeah, use the side chat if you guys want to network and stuff. Obviously, I'm gonna drop links in here. I'm gonna share another resource sheet as well. So it's already about to hit 3:20. So let's get started. I don't know if I have access to share my screen, but let's see. Can I? Nope. Hey, Carlos, you're gonna need to give me accessibility for sharing screen. I just dropped another document in there, multifamily resources. I added another website. If you guys see it, you guys can open it up. Share screen. Oh, perfect. Thank you. Let's get this show going. Actually, let me open one here so I can dump that one. Here we go. All right, because there's too many tabs on this one. that's not it. Here we go. Cool. All right, you guys can all see my screen, right? Can you guys all see my screen?
Yeah.
Perfect. All right, let's get started. So, as I mentioned, if you guys are here, welcome. It's Friday. Thanks for being here. Appreciate it. So Carlos and I, we host this every Friday. So if you guys want to bring in some friends, you know, as investors or looking to get into multifamily space, this is the place to be to underwrite deals. We do very basic stuff, you know, learning terminologies, learning how to underwrite deals so that you guys can pretty much get your feet through the door and then understand what a good deal or a bad deal looks like. This sheet, I give a lot of resources out for free. Don't share this spreadsheet, you know, outside of the group, just because there's a lot of time and effort put into this, creating all these formulas. This was actually from one of my mentors that I'm taking a course with, but I added a bunch of other stuff in here just to kind of give more data. And so what you guys are seeing right now is actually a sheet that I share with the Powerhouse Sub 2 group and in Carlos community. Okay. This will give you guys basically everything you need to see, you know, all the data points in about a 10-year pro forma. It does say 11-year, but that's because we want to understand like what's the projections going to be by year 10, and you need the year 11 to get that data. So if you look at the bottom screen where my cursor is, let me enlarge this so you guys can see it. This is what, here, let me pull this tab over. All right, so we have what's called a reverse valuation sheet. This is the tabs on the bottom if you guys are following. This is what we do on step one when finding deals. When we underwrite deals, we look at deals within 5 minutes. We don't want to overdo it. You don't want to get into a deep dive of underwriting a deal and just finding out that it doesn't, you know, it's not worth looking into. My mistake when I first started was I would underwrite a deal and spend an hour just figuring it out, and it doesn't really match up to what our buy box is. And that's one of the key things to understand with multifamily is you want to create a buy box for yourselves as an investor. So when you're going out there talking to a broker or maybe a potential commercial wholesaler, they're going to ask you, what's your buy box? And if you look to the right of my screen, something I'm highlighting right here, this is what I typically would give them. Right, this is our buy box. Very simple, very straightforward. You just got to tell them what class, and there's pretty much 4 classes: class A, B, C, D. You don't really hear of class D because those are like war zones. You really want to stay away from those. Those are very, very high risk, very stressful properties. You don't want to get into that. So class B, class C, you want to name your unit count, what kind of units that you're trying to target. In commercial, remember, anything 5 doors and up, you're already stepping into the commercial space. Okay, that's where commercial lenders give you a loan, is based off 5 units and more. Anything within 2 and 4 units, that's very, very small. That's still considered residential. So remember to keep that in mind. All right, so give me a second. Okay. So just to give you guys an understanding, you guys have to have class B, class C, or your classes that you guys are looking to identify, right? Class A is more for the luxury apartments. You got higher finishes. Those are more institutional buyers that look at class A's, guys that obviously have a lot more experience, but also need to park their money into something. For us, typical beginning investors to novice and more like, you know, a little bit more experienced investors, they typically like to do more of the value adds, where you can find significant opportunities in that. Then it's class B, class C. And then, like I mentioned, name your unit count. We typically like to do 10 to 60 just because that's where your directed seller comes in. You're not competing with a lot of hedge funds. You're not competing with private equity groups, right? That's why for us, 10 to 60 units is more than enough. Once you start hitting more on like that 100 units plus, that's when you're going to really have more competition with those big buyers that put down larger EMDs and can close quickly. So if you want to avoid that, this is kind of a good range to stay into. And then Texas is our state that we're focusing on with the submarkets of the 4 popular ones: Houston, Dallas, Fort Worth, Austin, San Antonio. So find a market, one market, find a submarket within that state, right? And choose which ones you guys like. And like I was telling John earlier, if you guys missed it, you know, he said he likes to focus on Texas and Florida. I always like to promote, pick one and then get good at that state. And then once you guys feel comfortable, start getting more deals, then you can shift your focus on finding properties in a different one. Then you also want to give them a price range, right? How many price per units, or give them a larger amount price range of like 1 million, 10 million plus, whatever it is, because these are based off, like multifamily is based off of price per door, right? Versus, let's say, a storage facility, those go based off of price per square footage. So it's a little bit different how we analyze deals with multifamily. And then there's 2 different things when it comes to the multifamily space. There's value adds, and then there is stabilized. Those are 2 terminologies you're going to learn. Value adds is exactly what it means. You're adding value to the property to raise your operating income, right? That's how you increase your value of the property. And once it's stabilized is just another meaning comparable to like a after repair value on a fix and flip. So it's very similar. It's just we call it stabilized value in the commercial world. Okay. You don't necessarily have to give them a cap rate minimum, but right now, with a lot of the interest rates still being above 7, as the interest rates keep climbing higher, and it sounds like what I'm hearing from other investors that are a lot more experienced than I am, they're seeing that there's going to be another rate hike, probably another 2 in the next few weeks. So as interest rates keep climbing up, right, a lot of these properties cap rates are starting to slowly catch up as well. So you're going to hear market cap rate, and every market has a different type of cap rate. Every class has a different market cap rate as well. So you have to find out from a non-biased broker that gives you an opinion of what they feel like that class type or that market cap is within that submarket, right? The submarket in Texas, Houston, might be a little bit different from something in San Antonio, right? Depending on the location, there's a lot of different factors that come into play when it comes to the cap rate. We like to target red states, landlord-friendly states like Texas, Georgia, Tennessee, Carolinas, Florida. Those are all the landlord-friendly states. You want landlord-friendly because you want to be able to evict somebody if they're not paying rent. Because the longer they stay in your property without paying rent, that's income that's not being generated from your property, right? You don't want to lose money, but as you own multifamily, there's going to be a lot of times where, you know, the market does shift, and people right now, there's evictions happening. You want to be able, I mean, it sucks to hear it, but it's part of the business. Remember, you own a business when you're owning these multifamily properties, right? So keep that in mind. Another thing is you don't want any regulations on rent. You don't want any states that have rent control, because what happens is, like for New York, I'll give you an example. In New York, you're only allowed to increase rent, I believe is 1% every year, right? If the property that you are planning on buying is $500 a unit, but then that's under market rents are at $1,000, your spread is $500. You can only increase it by 1%. Now you're stuck, right? So that is going to be a hard part about being a multifamily owner if you can't raise rents to the market rents. So here in Vegas, There's a lot of opportunity on that side of it where there's a lot of sellers that have under market properties, and you can jack up the rents to market value really easy. I'll give you an example. I sold a 9-unit back in October to one of my investors. I found the property on LoopNet. I underwrote it. I put it on social media. I ended up getting him because of another friend who's licensed. And I think the rents were like $500. The previous owner had the property for over 15 years, never raised the rents on the tenants for the last probably close to 10 years. So significantly under market rent. And I just actually met up with the investor that bought it yesterday to go see another 8-unit. And I asked him, what is he currently charging? He went from $500 being under market rent to $1,200. So that was what, $700 just in upside from increasing on one room. So remember, the value of your property in multifamily is generating income. That's where the base of the value is starting. You can't do that in residential homes. It's not analyzed that way. So hope that makes sense for you guys. Okay. If you guys have any questions, feel free to just chime in, unmute yourselves, and ask away. So let's go to the next part. So whenever you're underwriting deals, you always want to look at the way that this entire spreadsheet is built out. I made it so that all the blues are manual inputs. You see it right here. These are manual inputs. You can change anything in the blue. Do not change anything in the black. Do not change anything in the red, because those are already dynamic outputs where if I change, this is a very plug and play system. I literally have to change one thing and it adds or deducts from another cell. I made it very, very simple so you guys can literally just plug and play. So remember what I said, market cap rate is different in each class, but it also differentiates in each market, right? For a class C property here in Las Vegas, our market cap rate for a class C is 7.5. That's kind of like the average. There are properties that are trying to sell their properties down to like a 6%, 5%, and it just doesn't make sense. Those properties are just sitting on the market for days and weeks and months, because right now there's a little bit of misalignment with a lot of the sellers and the buyers, where sellers are still thinking that they're still stuck in 2021, right? 2021 market, 2022, and you got interest rates really high around the same interest percentage. And then you have buyers that don't want to buy at that rate, right? So there's a bit of struggle between both parties, so that they're waiting for it to calm down, what we call more of a stabilized market. So once that happens, then the demand for buyers are going to finally start kicking back in. But as of right now, it's not happening. So hopefully that kind of makes sense for you guys. But market cap rate for Class C properties, I'm just going to use Vegas just because I live here, is 7.5%. Market vacancy, you're always going to want to default a market vacancy at about 5%. And the reason being is because if, let's say, for example, we have 100 units that we're analyzing, right? 95% of it is occupied. The reason why we want to keep 5% as vacancy is because we want to test the market for a bit of a change, right? If our market rents are currently at $1,000 per unit, we want to gauge if the market is telling us, hey, can we bump it up to $1,100, right? That cushion of 5% will help us do that. So let's say it goes from 1,500 to 1,600. Somebody rents it out for 1,600. Great. Now we want to start pushing 1,700. Cool. We got 1,700. Now our occupancy rate is starting to climb up, right? Now we got 96, 97. Now you still have to give yourself some leeway, and you're trying to push that envelope, but you're kind of testing the market to understand, like, hey, are renters still willing to pay that market rent and more based off of what extra amenities you have in the property? Okay, so you always want to default the underwriting at 5% vacancy. Okay. Other income. Other income is basically additional income that you're getting aside from your base rent. And what I mean by other income, you can look right here. This is very easy. On the right side, you can see other income. These are just some of the extra items that you can consider as other income, like parking, late fees, pet rent, garage income if you have storage units, or garage income if you have like one of those covered patio type of parking lots, right? Those are garage income. If you have storage facilities, then you can create that for storage income. Then you have deposit forfeitures, other charges or whatnot. So that's other income. Okay. Oh, where did my, hold on 1 second. I lost my screen. Dang, I was on a roll. 1 second, there we go. Sorry, moving my stuff around. All right. Anybody lost? Anybody have any questions right now? No questions? All right.
I do have a question.
All right, what's your question, Mason?
The 95% vacancy. I remember one time, and correct me if I'm wrong, that also affects how much you get financed for. Is that right?
Yes. Good question that you brought that up. So commercial lenders typically, if they're trying to lend to your property, you need to have at least a minimum, I believe, of, I want to say 90%, just to be safe, between 85 and 90%, depending on who your lenders are. Remember, this is commercial real estate is a relationship-based business. You have to create relationships with these lenders. And if it's like the big banks, consider them more of like a hard money, right? You can't really negotiate much of the terms with them. But if you're creating a relationship with some of these lenders that are a little bit smaller, right? They're willing to kind of give you a little bit more of the leeway, fluctuation with their terms, right? They're a lot more negotiable. They're a little bit more flexible than like your typical Chase Bank or your national banks in your state. But yes, you have to have a minimum of occupancy about 85 to 90% for them to lend. So that's why it's good to know. And this spreadsheet does actually help you. There's a part in here where it's called deal metrics. And this particular area is meant for you to understand what a lender will prefer to give you based off of the loan type. I can go over that later. So thanks for bringing that up.
Yeah, cool. Awesome. I appreciate that. And just to clarify, now, if you were to bring this to a bank and it is below that threshold, do they just completely say no, or do they come back with like, we'll finance you up to a certain amount?
They're typically going to work with you because they want your business, right? So you have to meet their criteria, and they'll kind of give you a suggestion. If the lender is good, they'll make suggestions with you saying like, hey, maybe you got to bump up certain things, just depending on what it is. I'm not a lender, so I can't speak on that behalf. But yes, they're always going to want your business. That's why you always want to have multiple different relationships with different lenders, because whoever's going to give you the best deal is going to win your business, right? So you want to have you want to have different options whenever presenting your deal to other lenders, and they'll fight for your business. So whoever gives the best terms is going to get the business, is what they say.
Awesome, man. Appreciate it. Appreciate you.
You're welcome. Yep. Thanks for coming again. All right. So other income, that's what I just spoke about. Pro forma, that's another term you guys are going to learn. Pro forma market rents. Pro forma is just basically saying what's the future value of what we can rent these units out for, right? It's a future projection. And then there's also what's called as is or current or in place rents. That's what they're getting currently, as is, and what's in place. So those are the two terminologies for the rent side. Typically, the way that we underwrite this particular part of the spreadsheet is you're giving your future projection on a pro forma basis. What is the future value of this property worth, right? But you can also change it. You can also base it off of what the as is rents is, right? So let's say, based off what I have currently so far, rents are renting out at $750 and for 8 units at 50% expenses, the property value is worth based off of the income at $456. But if I want to know what the future value is based off $1,000 pro forma, by increasing the rents to $1,000, now my value of the property goes up to 608. So you can play with these metrics and it'll tell you and give you an idea. Remember, this is just more a guideline. This is just kind of for you to understand, like, hey, what is the property value estimated based off what the outputs are giving me? This is not like, you don't have to go strictly by this, but it's just for you to understand what does the property value worth based off of the all these item lines according to what you're giving it. So the next thing, capital expenditures, CapEx for short. What is the capital expenditure budget per unit? Typically, when you're seeing more of the value add components of a multifamily, you're going to see people say, hey, it's going to be 5,000, 7,500, 10,000, 12,500, 15,000. Those are typically, they round off to the zeros, but those are the typical numbers you're going to hear when you're going to hear a CapEx budget per unit. And that only includes interior. Okay, it doesn't include any exterior, but if you want to account for the exterior, then you just add whatever difference it is. So if I'm saying it's going to cost me 10,000 per unit, right? 10 units, make it easy numbers, 100,000. You're going to see right here, total rehab. That's just accounting for interior. If I want to say there's another 100,000 that I have to consider for exterior, then I just add it on and just say, hey, it's going to be 20,000 in total. So now you just doubled it. Now it's going to cost you technically 20,000 per unit. So that's how it works. Number of units, very straightforward. And then expense ratio. Expense ratio is very big. It typically is about 40 to 50% on the expense ratio, according to your gross potential rent, right? If you double click on any of these cells, it'll tell you exactly where they are attached to, right? B8 multiplied by B6 multiplied by 12 is 12 months. That's how you typically get a gross potential rent, or what we say GPR. That's how it's being calculated. And then less vacancy, which is at 5%. There's no other income. Now your effective gross rent would be 114,000 based off of the numbers that we're giving it at $1,000 market rent. Now 50% ratio, what it's telling us is that we're going to deduct 50% of that income right away, because that's going automatically towards expenses, right? And then now you're going to get what's called a net operating income, or what we say is NOI, right? Your net operating income is the factor that determines what the value of your property is once you divide it by the market cap rate. So how do we get this stabilized value? You double click this, and I have a cheat sheet on the bottom that it tells you exactly all the formulas. So if you decide that you want to plug and play and you want to know what the back of the napkin, this is exactly how you do it. You're literally just taking the net operating income and you divide it by 7.5%. And that's what your stabilized value is. Get good at doing the back of the napkin strategy, because that's all you really need. You need all these inputs, and you can literally do it on a piece of paper anywhere. But if you have your phone, whip it out, and then you can just go down here where it says formula cheat sheet. And I have all the functions of what you're trying to accomplish right here, right? You want to determine what the purchase price is. It's NOI divided by the cap rate. Or you just plug it into where the blues are and it'll spit out the factors for you, right? You want to determine what the NOI is, you plug and play, cap rate, blah, 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 and so forth. I made this very, very simple for you guys to just really go in here and just play with it. Just all you got to do is literally make a copy. So you just go to file, make a copy, and then it'll make a copy in your guys' folder. So there's a bunch of other formulas in here. If you want return on costs, you want something more of a forced appreciation, cash out refinancing, loan sizing. This part is really interesting, right? Going back to Mason's question about lenders and understanding what they see or what they're going to give you. You have an understanding based off of 4 different loan constraints, right? LTV stands for loan to value. LTC, loan to cost, right? DSCR, you're going to hear that a lot in the commercial. It's a debt service coverage ratio. I don't want to go too deep into all these stuff just because I want to get to the meat and potatoes of the valuation. But the last thing is the debt yield, right? So if you plug and play in here, these advanced formulas will determine what the lender is willing to loan on based off the different type of loan constraints. And what they're going to do is, if you see what the maximum loan amount is, right? And you see what the loan sizing difference is, okay? They're going to give you the cheapest amount that they can lend on based off of the metric, the numbers that the loan sizes go, right? So what I'm saying is, they're not going to go with the loan to value based off of this $1 million purchase. They're going to go with the DSCR loan because that is the lowest, less, what's the word I want to say? Less riskier loan type that they can give you based on the property, according to what you're giving it in this formula. All right. So you just literally put the interest rate, the amortization, the purchase price, what the appraised value or the stabilized value is. I should change that to stabilized value so you guys don't get confused. Boom. All right. And then closing costs, typically about like that 1.5%, 2%. That's your loan origination fee. Then you got your rehab costs. And then literally it calculates all your total investments for you. And then all these blues, like I said, and then that will be your manual inputs, and it'll spit out what the calculator thinks it should be. All right. So everybody's still following along, or did I lose you guys? Is this valuable for you guys to understand?
Super valuable.
Awesome. Cool. So let's see. All right. So I did add a few tabs in here. Like I said, this has been updated since yesterday. Like small little adjustments I always add in here, but I did add in the cap rate analysis tab, which is pretty cool. I can go over this on another time, but it's just basically the difference between cap rates. You know, it's not always necessary to find a cap rate based off of the market as what I was always thinking, like, oh, we have to get the highest cap rate. No, it's not like that in commercial. Everyone always thinks like the higher the cap rate, the bigger the returns. Not necessarily, right? It's really the higher the cap rate, the higher the risk for an investor to take on. The lower the cap rate is more stabilized, meaning less risk for an investor. So the risk factors are a lot less, right? So when you start stepping into like the 7.5 to about, 13, 14, 15%, you have a higher risk on the property because there's a lot more things that could go wrong. There's the year built is a lot older. So it doesn't necessarily have to mean about the cap rate being the highest. So I added that. You can look at the difference based on this example. Okay. What else did I add? I added the IO. This is interest only fee structure. This one's pretty cool. If you end up finding a creative finance deal and they want interest only period for the first year versus, the first 3 years, right here if you pay attention to these cells on F25, G25, right? If I change it to year 1, it's only going to account for interest only period for year 1, up to year 3, it deducts it. So it changes. It's pretty neat. I didn't have that in my original formula, but I added that. Also, here's another thing. Fee and waterfall. This is getting a little bit more advanced, but the fee and waterfall structure, this is more for if you're getting into the partnerships on, syndications or creating your own funds. you're gonna have that on the bottom right here, all the fee information, acquisition fee, construction management fee, asset management fee, disposition. And then you have like your GP equity splits, your preferred returns, all that good stuff. So this calculator literally does it all. You probably won't be using this, but I'm just giving it to you guys just in case you guys happen to have a partnership with somebody, or you get with Carlos and I, and we do a partnership fund. So that's just something that you guys can have. Don't give this away. All right. But let's focus on multifamily valuation. So multifamily valuation is a simpler version of those two spreadsheets. This is more of step 2. After you've done your reverse valuation, okay, you do this first and you find out to make sure if the price of the value is even close to what the seller is even offering, right? Let's say I'm underwriting a deal. The seller says, I want $1 million for this property, but the property based off of this calculator is telling us it's only worth 760. You might have to tell yourself, is it worth the conversation? Right? Are we near that price tag of what they're asking versus what the value is worth according to what the income is generating? Remember, multifamily is based off of income based, right? The whole entire goal is to take a value added property, decreasing expenses by also increasing income. Okay. The higher the income that you can generate, the higher your property value is worth. So remember that. So once you do step 1 on that reverse valuation, and you want to go a little bit deeper into analyzing a deal, and you have all their property financials, and there's 3 things that you want to get from a broker versus just a direct to seller. From a broker, if you're talking to a broker, you want to get 3 things: the offering memorandum, the T12, and the rent rolls. All right, I'm going to say it again. Offering memorandum, the T12, which is your property profit and losses statements for the last 12 months, and it has to be at least pretty current, not like 6 months ago. And then you want your rent rolls. Can anybody tell me why you want those 3? Aside from Daniel, because he's licensed and he might know the answer.
I don't know anything about the first one, but the trending 12 is going to give you the last 12 months of profit and losses. Is that correct? Like
Yep.
Expenditures, maintenance, etc. And then the leases are going to tell you when leases are up and how much money has been collected for deposits and so on and so forth.
Yep, exactly. What up, William? I haven't seen you in a while.
I've been busy as fuck, Stan.
Welcome,
Bro, jumping
William.
into these Zooms at this moment is like watching Netflix for me. See, phone's
Yeah.
ringing right now.
I bet. Dude, I haven't seen you in here in a minute, so I'm glad. Thanks for making it, man. And
Thanks for
happy
bringing
New
all
Year
this
to
value,
everybody.
brother.
Yeah, of course. Okay, so if you guys got that, right? The T12 is called the trailing 12 for the last 12 months. Rent rolls. I'll give you guys an example of some of these as well on one of my spreadsheet files that I can open up shortly. But the rent rolls does, if more often than not, if you're getting it from a broker, more than likely you'll probably get a little bit more organized profit and loss statements and rent rolls. But if you're getting it from a direct to seller, more than likely, if they haven't gone professional route and had a property management company sort their financials out, you're probably not going to get the best type of organization with it. So just keep that in mind. And then an offering memorandum is basically just an overview of the property details. Okay. On the documents that I sent you guys earlier with the resources, I usually go with this on the beginning, but Crexy, right? LoopNet, these are 2 free resources that I always recommend you guys get into. You can find offering memorandums in here once you guys create an account. Let's see, multifamily. Oh, sorry, not there. Here we go. So these are for sale, right? And then you can see where all the, there's new ones that just came out. I just realized that. You see how it tells you 7.04 cap rate, $5 million. So these give you an idea of where to try to sell it at. Actually, I went to go see this property yesterday. So this is the property I went to go see with my investor that bought the 9-unit from me. But when you log into this gives you basically everything: property facts, executive summary, and whatnot. Sometimes they do attach like the OM, the profit and loss statements, the rent rolls, but sometimes they don't. So you're gonna have to do a little bit of digging, or you have to call the broker up and then ask them, right? So for this, I mean, I can click access here, and sometimes it'll show this portion of it, but then sometimes depending on how they uploaded it, you'll have to get it directly from them. Sometimes it's in the links, but these ones are not. But aside from that, that's where you can typically find an OM. Let me find an OM that I can show you guys for the ones that have not seen an OM yet. Give me a second. Where is? Oh, there we go. Okay, I'm gonna show you guys an OM, but it's not multifamily. This is a property I was looking at for a commercial, what is this? A freestanding building for industrial space. So this is an OM, right? Every broker will create one if they're trying to advertise the property on market. So it'll tell you, every single broker is going to be very different, but they'll give you property highlights. They'll give you, this one was for a lease, right? Sometimes they'll give you mapping layout of the floor plan. They'll give you photos, basically every single detail about the property. This is very short. It's a 5-pager. I've seen fucking OMs like 100-page plus because they're so large in units. So don't get overwhelmed. The most common things that you want to get is just basically the numbers that you want to plug and play for the spreadsheet. Okay. Where were we? There we go. All right. So back to this. So this spreadsheet, it's a little bit more dumbed down compared to the fee waterfall and the interest only fee structure. So just focus on these two for now. Everything in here is this is just numbers I was doing on a different property, but purchase price, you can manipulate these however you want. Okay, you see how that just changed right here from this. This is conditional formatting I chose. So the way that this area works is that if it hits the targets, it'll turn green, and then if it's turning red, it's just because I'm matching it up based off of these values right here. So I'm just kind of correlating what the colors look like based off of the leverage IRR, which is the internal rate of return. It's just kind of identifying like, hey, this is more of an opportunistic high risk property at that price point, right? But that's not realistic. And then if we start changing those values, it obviously correlates. So if we're staying on the left side of this map of this spreadsheet, these are the important key metrics to just kind of look at, right? Your price, your purchase price, this is where you want to plug it in. It determines based off of the number of units. We're looking at 4, so it's 125,000 per unit. You put in your closing costs. Obviously, these are defaulted to whatever I left it at. Your capital budget, right? You always want to take in consideration what your capital budget is, when you're going to start it, when is it going to be completed, right? And then you have your capital reserves. You always want to make sure 3 things when analyzing and underwriting a property. Hold on a second. There's 3 things you want to remember when analyzing a property. For property expenses, you always want to have property management fees in place, your capital reserves, right? And your repair and maintenance. Those are things that you want to consider for a rainy day, but you also want to factor it in as a default, right? Same thing we do with single family homes. what Pace and our mentor has taught us is you always want to have a war chest to put away for a rainy day. So let's say for every $100, 10% goes to management fees, 5% goes for the CapEx budget for the reserves for a rainy day, and then you always want to put away at least 5% for repairs and maintenance, because those are things that you cannot predict. Okay, so between 15, sometimes between 10 to 20%, you're putting away automatically for those types of line items. Okay. Capital reserve growth, 3% each year. That's pretty much standard. And then you have your financing information, right? When you're analyzing a deal, you're going to want to, when you have that relationship with your commercial lenders, they're going to tell you what their terms are, right? Is this interest only? Is this amortized? More often than not, it's usually amortized. Right now with commercial, 65% loan to value is pretty standard. Obviously with the market shift, lenders are taking less risks, so they're going to give less on that loan to value aspect. During the summertime when freaking everything was hot, they were loaning like 80%. Usually for commercial assets, the typical loan to value is about 80-20. So this kind of shows you that they're taking on less risk, so they don't want to lend as much money. Borrowing money also is getting more expensive. So I always underwrite conservative, and you guys always want to write conservative yourselves. You never want to underwrite very aggressive, because you want to make sure that you have enough cushion when something happens on a rainy day. Your HVAC system goes out, you got plumbing issues, you know, shit like this happens. I was just with one of my other commercial mentors last night having dinner, and he said the day before Christmas, he was in Seattle and it was cold, right? I don't know how many units he has, I can't remember, but he had 18 different units without water. There was a water leak happening somewhere and they had to shut off water. So imagine that happening to your property, right? So those are things that you cannot predict. It happens whenever it does decide to happen. So just keep that in mind. Commercial lenders also amortize usually about 25 years. But with if you know how to do creative financing, you know, you can negotiate your amortization to about 30-35 years. I mean, Pace has gone from 50 years, I think, was one of his latest creative finance deals for multifamily space, which is wild. So this is your standard, about 65%, 1% loan origination fee. I'm writing it at 8%. I think interest rates are about 7.5, 7.25, but it's all based on who your relationships are with. All right, sale information, exit cap rate. Remember when I said in the reverse valuation, your exit cap rate is always what you're going to be determining based off of your submarket. So if I'm analyzing a Class C, my exit cap rate is going to be 7.5. Maybe I'll do a 7. It really just depends. Cost of sale is when you exit. Are you hiring a broker to help you guys? It's basically like a co-op commission. Are you paying the seller? Are you paying the buyer to advertise your property? And then when are you looking to exit the property? Typically, the most common is about 5, 7, and 10 years, right? So you can adjust for that. But if you're just looking to flip it, the first 2 years, 3 years, you can adjust it for that as well. And every time you adjust, all these also adjust. Before I updated this, the last time I saw you guys back in December, everything here was not here, right? I just added this in the last week. So these are new: going in debt yield, exit loan to value based on sales price, your year one expense ratio based off of the inputs I added on. And then this is something I should have added a long time ago, which is your potential profit, right? Based off of the metrics I've given it. And then also your loan to value on a refi. If you decide that you're refining the project out during the middle of your ownership, right? A common strategy that I've been hearing right now is like the infinite, what is it called? Infinite something. I'm like having a little brain fart. But what they do is, their game plan is to hold it for 5 years. But in the next 2 to 3 years, the investor refis the property out, collects that money, wipes out all the investors, but keeps the investor in the property, but gives back their money plus some. That's where the loan to value refi option comes into play. Okay. And then down here is obviously for you guys, just to kind of give you guys some guidance, what a good cash and cash metric is, what the equity multiple is, the IRR, which is internal rate of return. Like if these terminologies are confusing you guys or are telling yourselves, I don't even know what that means, get educated on what these terminologies are, because it's very, very important to understand these acronyms, right? When I first got into this space, I had no idea what a lot of it was. So I went out there, got education through YouTube, which is one of the best free content you can get books, right? Or come into these classes like Carlos and I have every week. The commercial underwriting is every Friday. And yeah, you'll learn this over time. Let me give you guys, I'm going to share with you guys another resource that I forgot to give. And I always forget, or I always give it out, but I just totally forgot today. I'm going to give you guys the 7 commercial terms that you guys should know. Okay. You guys getting a lot of free stuff again today. So hopefully this helps you guys. You guys can add some stuff to your tool belt, but here you go. Look in the side chat. That's another document. And let me see. Let me give you guys one more since I'm feeling really nice today. All right, deal analysis 101. This is my last document I'm going to share with you guys. I know this is a lot of information, but hey, if you want to be the best underwriter, you don't even have to be the best underwriter. If you want to just understand the terminologies, and you want to know how to talk to brokers and investors, because you're going to have to eventually, right? These are the things that you need to know. All right. You're not going to learn this all in one night. It's not an overnight type of understanding with commercial. It takes months. Listen to some podcasts. I think Carlos has a guy that he listens to on YouTube, really, really good channel. I listen to him. But if you want to know multifamily, you want to get into the space, learn the lingo, because you're going to get tested by brokers. You're going to get tested by your peers in the space. And it's okay, right? You don't have to know everything, but just start by reading some of these things that I'm giving you guys as resources. Cool. Let's see.
Quick question, Stan. What is unlevered profit versus levered profit?
Good question. All right. So there's 2 things, right? When you're looking to borrow money from a lender, you're leveraging debt. That's what leveraged is. Unleveraged is if you're buying it cash. That's the difference. Does that answer your
Thank you.
question? Perfect. Cool. So let's move on right here. So to the right side of the calculator, this is where you're putting in for your unit mixes. Okay. These are all, like I said, they're always dynamic. You can change anything in here. And it gives you all the averages on the rent. And this all are connected to this spreadsheet in particular. Anything here, these can all be changed as well. So when you see a profit and loss statement, you're going to have a lot of itemized item lines. Just put them all within, you want to just compress them all together. You don't have to be exact, right? You're just trying to get as close as possible. Once you start doing more of a deep dive, then obviously use the other calculators. But the whole goal of underwriting is try to underwrite deals within 5 minutes or less, right? The only time you're really gonna use this is if you're really bored and because you're trying to understand the calculator, or once you find a deal and you want to go a little bit deeper into it to make sure that the numbers really make sense for you and for your investors. Okay. So that's the whole idea. On the right side, it tells you based off of your physical vacancy and then how much rent growth that you are. This is pretty standard, but let's say you find a property that's like 80%, or let's say it's 20% vacant. The next year, it's taking a little bit longer, 10%. Those are being adjusted on this side for vacancy. So I just keep that, to be honest, at 5%. And then that's really it, guys. Any questions? No? Carlos, are you here?
Yes, sir.
I think you wanted to go over some underwriting today on one of the properties that you said you had.
Yeah. Jacob actually emailed me over some stuff. If we could underwrite that.
You already emailed it to me?
No, I got it emailed to me. Let me see if I'll just forward it over to you.
Oh, okay, got it.
Hey, Stan,
Yeah,
while
it's
he's
kind of,
emailing that to you, I have a quick question.
Yep.
One time we had a discussion, and you were asking, because I was speaking to a realtor about a property in San Antonio, and you asked for me to say, what is you were asking me to ask him what a whisper price would be. What does that mean? I mean, I was able to get around it on my own, but how does that usually used in this space?
Sure, that's a good question. So you're going to hear that whisper price. I actually used that today. So I was looking at a 14 unit here in Las Vegas, and I called the broker. The broker is a friend of mine. They were selling the property for 1.8 million, right? And I'm like, 1.8 million, 14 units. That's a little high. It's about like almost 169 per door. And I was like, what is the whisper price? And the whisper price, she was just like, they're willing to sell a little bit shorter, a little bit cheaper than the 1.8 once that we get a little bit more understanding of what the NOI is. But the whisper price is pretty much the way that we use it is just like that. What is the price that they're looking to sell it for that because sometimes they're just advertising a price because they know that people are going to kind of negotiate it down. So if you have a good relationship, or you don't necessarily have to have a relationship with the broker, we typically just ask, what's the whisper price? It's just saying like, hey, what are they really okay with selling the property for? Sometimes they'll tell you, sometimes they won't, but at least it's kind of what we say, a price guidance.
Okay, cool, man. I appreciate that. Yeah, his response was, he gave me a number, right? But he was just like, I just have to be careful because I'm a realtor now. I guess he wasn't a realtor before when I first started talking to him. But yeah, he was just, So I still talk with him. So I appreciate it, man. Thanks for clearing that up.
Of course. Yeah, it's really just kind of giving you the inside scoop, It's like that. What's the whisper price, bro?
Gotcha. Cool, thanks.
Yep. Good question. Anybody else?
I had a quick question about CapEx. I've heard that anything that doesn't require like yearly checkup or maintenance, like a roof, falls under it. So what else would qualify for CapEx?
Yeah, good question. So CapEx is basically like your one-off expenses for the year. I think Carlos was saying that on his boot camp, right? So there's a difference between capital expenditures and your actual operating expenses. If you don't have reoccurring expenses, or if you have reoccurring expenses, then that's what's considered your operating expenses. But if this is your one time, like you're going to paint the roof one time this year, you're going to do the road, right? You're going to turn a classic property into a premium. That's what's considered your capital expenditures. It's just the one-off expense.
Gotcha. Okay. So like, let's say like if the apartment added fire pits to the outside area, that would count as CapEx?
Correct. Yep.
Okay.
Exactly.
Cool. Thanks, man.
But if you have like a contracting servicing company that comes and cleans like your yard, that's more of an expense,
Okay. Gotcha.
right? Because they're hiring that person at least every month to come in and do maintenance for. It's a good question too.
Are you in the calculator there? Are you under cap X, the line item there? Are you using that same line item for like add values, value add stuff, or is that different?
Yes. So capital budget, this is more for the one-time CapEx. For the capital reserves is two different things. You see how I just kind of put my mouse over here and it just has a comment. So this is more for you guys as a guide that tells you, hey, capital reserves is about 300 to 500 a unit, right? And then on the right side, I have it here as well. So you guys have a guidance, but just for this side on the left, capital budget is just more of a CapEx one time, because it's going to ask you what's the year of your renovation versus when it's completed. And if I do year 2, based right here on the capital improvements, it splits it in 2, right? On F22 and G22.
Awesome, thank you.
You're welcome. All right, so I got Carlos's email. Let's look at this. Okay, so this is originally 2 million Whisper price. Whisper is now 1.8. Seller is looking for at least 75% down, 30 days to close. Perfect, and this is highlighted. So let's do some quick, I'm gonna reset this to 0. Reset this to 0. All right, so this is a Class C. Their cap rate that they're telling us is a 4.8, which is really low for a Class C. Nobody's, I'll tell you right now, nobody's really buying 4.8 cap rates on a Class C, right? As I was telling you guys, with interest rates going up, typically 7.5% is where the average is. And then how many units is this?
It's a 12, I
12.
believe. Yeah.
Yeah, 12 units. Okay, so let's see, the deal is available free and clear. Okay, so this is potentially a creative finance deal. They're asking 1.8, 150,000 per unit. Many legacy tenants rented 500 plus below the current market rent. 4 new leases signed at 1,265. Room to increase, okay, minutes, okay, loan assumption, not necessary. Okay. So. Awesome. Here's. Let me see, let me download this file real quick. Oh, here it is. All right, so this is the OM. 24 pages. It's good to see OMs that have photos, right? Because now you can kind of see, once you start doing underwriting, you're going to see all these different types of properties. You're going to, right off the bat, you're like Class C, right? And then you kind of stroll through it, gives you all the property financials and overview, index, executive summary. All right, so here's the address, total units 12. So average unit size is 880. And the rents per unit is 1,000. And it's 100% occupied. Remember, when we underwrite, it's always going to be 5% vacant. Okay. No matter what, don't underwrite at 100%. Okay. So this is a garden style brick walls. Okay. That's not important right now. So what I'm looking for, obviously they have, they'll have the pro forma, right? So they'll tell us what the actual rent is versus the market rent. So how I would do this is if I go back to my spreadsheet, 12 units, 2-1. Okay, I'm going to go to the rent breakdown tab. Okay, I'm going to reset all these to 0, right? 0, 0. Okay, so what did it say that we had? We have 12 units, straightforward, 12 units, and these are 2-1s. Okay, Boom. $1,000 per rent, as is. And then they're telling us it's 1,200 for market rent. So over in place means there's $200 spread. Okay. So if we had more different unit mixes, then obviously it would be a lot more different, but this is very straightforward. So now I take that and let's say go back to reverse valuation. We're going to use the as is for now. Right, $1,000. That's all it's telling us. It's $1,000 as is rents. We don't know what the capital budget is, but because we haven't really looked. All right, so year one plus rubs, other income. Okay, so other income, this is a T3, T1. So T1 is 1 month annualized versus T3, 3 months annualized. So that's not what we're looking for. We're looking for T12. And this is old because this is May. Okay, these are the things you got to look for, right? But you see how this is a little bit more, this is a lot more organized. It tells you exactly what the line items are. You can literally pull these out and put it on the other spreadsheet, but that's not what we're trying to accomplish right now. We're just trying to do a really, really quick valuation of what the T12 is.
The T12, I believe, is in a different file. Separate
Yeah,
file.
I did see that, but I'm just kind of looking at this as in, this is just an example for the OM. I did see that file though. So
Yeah,
let's just,
I saw like the same thing you just saw, that this one on here is older, and on the T12, the actual files, I think it's newer, September or something. Yeah.
okay. So let's just assume, okay, we're just gonna do this because this is an example. Today, this is December. Let's just assume this is December. So for easy numbers, because they already have other income in here told put in for us. That's a total of 12,520. We can add that, right? 12,520 divided by 12 units. Because remember, we're doing per unit. It's 1,043.33 as other income. And then we're just gonna kind of guesstimate. They're saying that operating expenses is about 45. So I like to write conservatively. We can do 50, but since it's saying 45, let's do 45 just for shits and giggles. Okay. What was the, okay, so we got pretty much all our metrics, right? And they're trying to sell it for, they were originally trying to sell it for 2 million is what they were saying. But this is a free and clear property. So if they're trying to say that they wanted to sell this at a 4.8 cap, this technically would be worth $3.88 million. But nobody was buying it from them at that, even at 2 million price. So this is as is if they were going to sell it at a 4.8 cap. But I don't think they're being realistic on that. So let's see, 7.5. There we go. So technically, they were probably selling this at the 2 million at the 7.5. That's why brokers underwrite things a little bit different just to make it sound like it's appealing. Remember, you see the difference? 4.8 is what they were trying to advertise for. But 7.5 is actually the original $2 million price. But then now they're saying the whisper price is 1.8. So maybe it's a 8 cap. There we go, closer. So maybe 8.25. Right, getting closer, 8.5. So this property probably close to generating, there we go. With the current in-place rents and an income, and this is very simple. Look, we took less than probably 10 minutes. This property is generating right now at an 8.7 cap, right? 8.75 at that 1.8 is what they're trying to sell it at. And this is at an in-place as is rents. Remember, their pro forma is 1,200. So because we added $200 of upside per unit, that gave us a different valuation. We went from 1.8 to 9, 1.976. See that? So and this is, remember, this is without even accounting for any rehabs, right? We didn't account for any capital expenditures, right? We're just really just looking at the price. So that's really how quick it can become. And I'm going to show you guys a little trick here. If we go on formula cheat sheet, we're going to do forced appreciation, right? Current market rents, 1,000. Market rents pro forma, 1,200. How many units? There was 12. For 12 months at a 7.5% cap rate, the added value that you can do for just a $200 increase gives the property value an extra $364,000, almost $365,000 in operating income value from raising your rents for $200. How crazy is that? So what's the next step, right? You're like, okay, great, Stan, you found a deal. This might be a deal. What do you want to do? Do you want to get, you can analyze this a little bit deeper and really plug and play the numbers. I don't know this market myself. Where is downtown Austell, Jacob?
It's in Cobb County, right outside of Atlanta.
Okay, so this is Georgia.
Yeah.
Okay. Okay. So that's not my market. I don't know anything about it. So for me, I would have to call some property management companies, some brokers, just to verify what the average market cap rate is within that submarket, right? And we haven't even fully looked at all of this OM. You can see what the comparables that they've provided, but that's pretty much the next step. Like, find out, like, hey, get a little bit more information, because this is a free and clear property. You should negotiate and see what kind of terms that they're looking for. Get on the call with Carlos and see what you guys can negotiate, because this might be a deal. They lowered it down to a 1.8, but you got to dig a little bit deeper. The outside looks great. It looks super nice on the outside, but we don't know what the inside looks like.
I think they have one picture of one of the units somewhere in there. Yeah,
Okay.
right there.
So here we go. All right. So property features, they got large living room, new windows, tile kitchen, backdoor accessibility, kitchen backsplash, stainless steel. Okay, cool. So out of the 12 units, did it also mention how many properties still need to be renovated?
Jeez, I could have sworn I saw it somewhere. I'll double check.
Immediate cash flow significant. Okay. Updated paint. Sometimes they tell you, or you could just call the broker directly and just be like, hey, out of those 12 units, do you know how many of them still need to be changed over to a premium property, right? And they'll say, 4 of them have been renovated, 8 still needs to be turned over and renovated to premium. So that's really it, guys. So it's 4:30. I'm going to leave the floor open to some questions. Hopefully you guys did learn a lot from this session. I feel like this is the best one so far for a small group. You guys learn anything? Hopefully you guys did.
Heck yeah, man. I got a quick question for you.
Yeah.
The cheat sheet section that you used, you stated that there was a $365,000 increase in value. Is that right?
Yeah, right here.
Mm-hmm.
Yep.
So is that accounting like the expenses that you would have to pay? Is that like net, or is that just like gross? I mean, how do I look at that?
This is gross, because remember, you still got to take away expenses, right?
Yeah. Okay.
So everything is always gross before net.
So
But
maybe, depending on the market, I guess, 50% of that is already going towards expenses and whatnot, right?
Mm-hmm. So imagine just take expenses off 50%, exactly. So divide by 2. So you can technically net another 183,000, give or take. And then per value per unit, just from raising it $200, that would have been another 2,500 per unit. So yes, forced appreciation is great with multifamily. You're forcing the value up.
Well, thanks.
You're welcome. All right.
Yes,
Well,
Dan, I appreciate you taking a look at that property for sure.
yeah, you're welcome. Anybody
Hey,
else?
Stan, I have a question regarding the DSCR. The
Yep.
DSCR is calculated on an interest only, but you also have to add the amortization for this DSCR, right?
The way the DSCR works is just basically saying how much can your net operating income cover your debt service, right? What is debt service? Your debt service is your principal and interest payments combined. So how many times does this $50,000 of net operating income cover my debt service? And for here, looking at F36, it covers it by 1.67 times over, right? So if I double click here, you see how the value.
Yeah.
So you're taking
But the-
NOI divided by your debt service right here.
Yeah, but I'm saying the calculation is with interest. Even though
Correct.
your payment could be interest only, you still calculate it with amortization.
Yes, yes,
Yeah.
correct. So that's like a very popular loan constraint or a lending strategy that a lot of commercial investors like to leverage is a DSCR loan.
Yeah, it's being used a lot for Airbnbs now.
Yeah, and it's pretty standard, around 1.25 is your typical standard DSCR constraint, 1.25 times. During the, I believe during the summer, I think during the summertime, I was hearing some lenders leverage a 1-to-1 DSCR, which was crazy. But not right now. You're not hearing anything that sometimes you might hear now like 1.35, 1.3. So they're raising up the DSCR minimum because of the market shift.
Stan, I had a quick question regarding cap rates, and it seems like, I know you said that the higher it is, it's higher the risk. Is it not just depending on the cap rate, but is it just dependent on the investor regarding how much risk they want to take? Like, where's the sweet spot is my question.
Well, yeah, the sweet spot is really up to you as the investor, what your experience is. I kind of base the cap rate just according to what the financials look like, right? And it depends on what the location. There's a lot of factors. There's not really one thing with cap rates, as you probably are going to hear a lot from other guys that underwrite properties. Typically, let's say for a class A, you're going to see cap rates in the 4.5, sometimes 5. And then it just kind of fluctuates between like that 5.5 to 7.5 for a class B. And then the higher, the older the property, the more value, the more work it needs to be done, the higher the cap rate becomes, right? And then the older or the longer that the investor or the owner holds onto the property, your cap rate starts to increase as well, because you're doing less expenses and you're just increasing income, right? Because it's less maintenance over time. Well, no, not necessarily less maintenance over time. It's just they're paying down their principal as well. So that
Gotcha.
comes into play. But there's not really a sweet spot. I would say right now, if I was to say, hey, what type of cap rates am I looking at? I usually filter it out at 7.5 plus minimum, because I want to be aligned with what the interest rates are in the market, right? Back in the summer, you can get away with selling a class C at 5.5. Not right now, because interest rates back then was like 4, right? Even under sometimes. So right now, a lot of people are under. Right? It doesn't make
Right.
sense for you to buy a 5 cap Class C when interest rates are at 7 plus. You're under by 2 points.
Yeah. Gotcha. Okay. Cool.
Yeah. So when that happens, you're gonna have less cash flow into your deal. And it just depends. Every asset is different, right? It depends on you as an investor as well,
Mhm.
because what's your exit strategy? Are you using this for tax purposes? Are you using this to cash flow? Right? It depends on what you're exiting for. And sometimes, like the big guys, they just need tax deference. So they just need to park their money somewhere. It doesn't necessarily have to cash flow,
Mhm.
but they use it as a tax incentive to buy the property.
So those people are willing to take probably lower cap rates.
Yeah,
Okay. Got
exactly.
it.
Because over time you can always refinance it out, right? And get a better
Yeah.
rate.
Cool. Cool. Thanks, man.
Cool. Anybody else?
So if I was looking at a property, sorry, can I ask one
Go
more?
ahead.
Or no, are we good? Okay.
Go ahead.
I know. So if I'm looking at a property and the cap rate is whatever it is, I have to evaluate that. And I'm looking at it. I should really consider the condition of the property and whether there is potential to increase rents or bring in value to even see if this is a deal, right? Like that's what you're looking for. Like you're looking for added value add stuff.
You always, well, yes. I mean, it just depends on you as the investor. For us, obviously, we're always looking for properties that we want to add value to because that's like your biggest return, right? Because you want to capitalize on more income, right? That's our objective. Your objective could be something else. You just want to park it and get some tax deference, tax benefits with depreciation. But for us, for my group, we want to turn over the property and give it, not lipstick on a pig, but we want to make sure that, it's a lot better condition to kind of to improve the neighborhood, right? We want to add extra amenities based off of whatever else is around that specific subject property.
Got it. Thank you.
All right. That's it, guys. I'll see you guys next week and you guys have a wonderful weekend.
Thank you, Stan. Great job, brother.
You're
Yeah,
welcome.
thanks again,
for coming,
Stan,
guys.
man. Appreciate it.
You're welcome. All right, guys. Have a good one.
Thanks so much. Bye-bye.
Yeah. Appreciate you, Stan.